This month I've used just 3 option strategies that have net me a 90% win rate over the last month, so hopefully I can pass these consistent profits on to you in this video. Hi all, my name is Greg and I make videos about the stock market and options trading. Today we're going to be talking about 3 of the best option strategies that I've been using over the last month. So to break this video down for you for each strategy, first we're going to go over the basics on how each one works. After that, we'll talk about when to take profits using each different option strategy. And finally, we'll talk about the risks associated with each strategy. And you'll definitely want to stick around for that because you might be on the hook for tens of thousands of dollars if the trade goes the wrong way. But before we get into it, if you enjoy this type of video and you want me to make more option tutorials, make sure to leave a like down below and subscribe if you're new to the channel. With that out of the way, let's talk about these strategies. The first strategy that I've been using over last month is the wheel strategy. And this is made up of actually 2 different option strategies. The first half of the wheel strategy is a cash secured put. And in a cash secured put, you need enough money to buy 100 shares of a stock at your strike price. And for me, I chose to do this on SSPK this month. I sold a put option with a $20 strike price expiring on April 16th, and I received $280 of credit. This means if SSPK is trading anything below $20 by April 16th, I'm willing to buy 100 shares at $20 no matter what the price is. It could be $10, it could be $19.99. I'm still buying those 100 shares at $20 no matter what. But technically, we're actually not paying the full price for the shares. What we're paying instead is actually our break-even price. Since I got $280 of credit, this was applied to the $2,000 of collateral that I put down, which would bring my cost down to $1,720. So technically, we're paying $17.20 per share and not $20. But if SSBK is trading anything above $20 on my expiration date, say $20.01 or $30, I'm off the hook. I don't have to buy any shares and I still get to keep the $280 of credit that I received. This credit is mine as long as I don't buy this option back. But typically I don't hold these into expiration. What I like to do whenever I want to take profit on these is I wait till I'm at about a 50% profit a week before expiration, or the week of expiration, I seek to take profit at around 75% or more of the premium that I was paid. So if I was actually paid $100 in premium any week before expiration, I'd be looking to take $50 of profit, and the week of expiration, I'd be looking to take $75 or more. If I'm unable to take these profits before the expiration date, I'll just let it expire, buy the 100 shares, and start to sell covered calls. I've been using the strategy over the last couple of months after the USPS decision for Workhorse, and using covered calls over the last couple of months, I've made over $800 in premium. I use the same take profit strategy of 50% any week before expiration and 75% or more the week of expiration. If I'm not able to take these profits, then I'll just sell the 100 shares and start to sell cash secure puts, and then we just keep the wheels turning. But of course, this strategy isn't foolproof. There are risks that come along with it. The risks of the strategy come with holding these options into expiration and actually having to buy or sell 100 shares. If I agree to buy 100 shares of SSPK at $20, but for some reason their stock falls down like a knife and it's trading at $10, I'm still forced to buy 100 shares at $20. This means automatically I would be down 50% on this investment. But this doesn't mean I have to take a loss overall. What I could do to recoup these losses is sell cover call options against it, and this would bring down my cost basis even further. We talked about how my actual cost basis for SSPK would be $17.20, and if I got filled to buy 100 shares at $20 and I kept selling cover calls against this, I might eventually be able to bring down my cost basis to $10 per share. I've been using this strategy on Workhorse over the last 6 months or so, and my actual cost basis for my Workhorse shares is about $2 each. But of course, you still run a risk whenever you're selling cover call options. If the stock just flies by a ton and starts going to the moon, you're going to take a huge unrealized loss. I might agree to sell 100 shares of Workhorse at $19 using cover call option, but if suddenly Congress decides to flip the USPS decision, Workhorse might go up to $50. And that pretty much wraps up the risk for the wheel strategy. So let's talk about credit spreads. Credit spreads are similar to the wheel strategy, but you actually don't have to buy or sell 100 shares of a stock. Instead, you're using a long option, you're buying an option, and then you're selling an option against that long option. So in order to use this strategy, you're going to sell a call option or a put option depending on which way you think the stock is going to go and what price you think that it won't cross. So if I think that a stock is going to be trading above $100, I'm going to sell a $100 put option just like I would with a cash secured put, but then I'm going to buy back an option at a lower strike price. And the lower strike price really depends on how much money you're willing to put down in this trade. If you're only willing to put $100 down, then you'll buy back a $99 call option and have $100 of collateral. If you're feeling a little more risky and you have more money to spend, you might buy back a $90 call option and put down $1,000 of collateral. But that's just if you think that a stock is going to go up. If you think that it's going to go down or stay flat for the most part, you're going to use a call credit spread. And in order to start using a call credit spread, you're going to determine a price that you don't think the stock will go up above, and then you're going to sell a call option at that strike price, and then buy back a call option at a higher strike price, depending on how much money you're willing to put down again. So if I think that a stock isn't going to go anything above $100, I'm going to sell a call option against it at a $100 strike price, just like I would with a covered call, and then I'm going to buy back an option with a higher strike price, depending on how much money I'm putting down. So if I want to put $100 down, I'll buy back a 101 call. If I want to put $500 down, I'll buy back a 105 call. I've used this strategy a few times over the last month with Fulgent, Square, and Snapchat, and I've closed 3 of these 4 trades, and all 3 of them have been profitable. For taking profits, I use the same strategy that I use for the wheel, taking 50% profit any week before the expiration date and 75% or more the week of expiration. This means if I get paid $50 for a credit spread any week before expiration, I'll be looking to buy this back for $25, and any day the week of expiration, I'll be looking to buy this back for anything under $13. And the thing is, with credit spreads, you want to close these options early, otherwise things can get unexpectedly messy. If both of your options expire in the money, you'll take your max loss, which is equal to the difference between the 2 strike prices minus the credit that you received. So you can actually lose more than the credit that you received depending on how wide the strike is and how much you got paid. If I have, say, a $5 spread and I'm paid $100 to put on this trade, my max loss would be $500 minus the $100 of credit that I received, which is a max loss of $400 or 300%. And if things go really south and you get super unlucky, you might be on the hook to buy or sell 100 shares of the stock. This is when your defined risk strategy becomes an undefined risk strategy. If on your expiration date your options expire in the money at 4 p.m., your brokerage might start to exercise both of these options. But then if your long option comes out of the money, they'll no longer want to exercise that option, leaving you with just one short option. This means if you had one short put option, you're going to have to buy 100 shares of the stock. And if you had a short call option, you'll need to sell 100 shares of the stock. And if you don't own that, you're going to be forced to buy it and then sell those shares at whatever strike price for your short call option. And this is why it's always best to close your spreads before expiration, whether you're at a profit, whether you're at a loss. And this goes for debit spreads too. Debit spreads are typically going to be a cheaper option than credit spreads because with the credit spread, you have to put down collateral, but with a debit spread, you only have to put down what these options are worth. Just like with a credit spread, with a debit spread, you're going to choose a stock price that you don't think the stock will go above or below. You're going to buy a call option or a put option at that strike price, and then you're going to sell a put or call option above or below that. With a call debit spread, you want the stock price to stay above your 2 strike prices, and with a put debit spread, you want the stock price to stay below your 2 strike prices. So if I think that a stock is going to be above $100, I'm going to buy a call option with a $100 strike price and then sell a call option with the lower strike price. And with a put debit spread, if I think that a stock is going to be below $100, I'm going to buy a put option with a $100 strike price and sell a put option with a higher strike price. The strike price that you sell really depends on how much these premiums are going for and how much debit you're willing to put down in these trades. I use this strategy on Fulgent this month with a $100 and $115 call debit spread, and I opened this call debit spread for $184. If all things went right and Fulgent was above $115, my top strike price by expiration, I would have turned this $184 into $500 for a $316 profit. But actually I ended up taking profits early on this whenever I saw Fulgent was just flying up by a ton after the earnings report, and I was able to take 30% profit. And generally, that's when I like to take profits for debit spreads. I sort of see them in the same way that I see regular calls and regular puts. And with those strategies, I usually aim to take profit at 30%. If this option went against me though, and I held this Fulgent spread into expiration and Fulgent was trading anything below $110, I would have lost that full $184 that I put down in this trade. And that's the risk that comes with debit spreads and pretty much any other long option. You can lose whatever you're putting down. So don't go putting your entire portfolio going balls to the wall with a single debit spread. I did that back in September for Tesla on their battery day, and I lost $12,000. And that's the 3 strategies that I've been using over the last month. I made 10 trades, 9 of them have been profitable, and I still have 4 that have yet to be determined. If you want to know my next trade, I post all my trade alerts on my premium Discord, which is going to be linked to my Patreon, which you can find down in the pinned comment below. And that pretty much wraps up today's video, but before I go, I want to say thank you to all my patrons for their support. Thanks for making it all the way to the end of this video, and as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.